Okay, good morning, everybody, and welcome to the Daily Energy Markets podcast. It is Thursday, January 19th, 10:30 in the morning here in the UAE, at least. Different times, of course, all around the world. And we see Brent crude oil trading this morning just a little bit above $84 a barrel, but a 1% decline in early trade today. It seems that the big question that everybody's trying to answer is how quick will China open? Is it a today story? Is it a tomorrow story? Is it the day after? Matt Stanley, partnership lead, Middle East, Kepler. You guys know the answer to everything, given your bionic eyes on every ship on the planet. Tell us, when will China open, the exact date, and not when it will open, when we can say China's back?
Tomorrow at 10 a.m.
Thank you. That's it.
No worries. Can I go now?
Yes, you can go and celebrate Arsenal being the best team on the planet. Yes.
I didn't say it. I'm
saying it for you. I am saying it for you. I am quietly hoping and praying that you will dethrone our Manchester neighbors. But anyway, another story for another day. When can we say China's back?
Well, I think it's been the story of 2022 is when China were going to come back, and praise the Lord, at the end of December they said they were going to. Now, how that actually rolls out, look, I'm not so sure. I mean, it's the much needed spike in travel demand for jet fuel that the market was waiting for. That will push the whole energy complex up. But I don't think, the story this year, why Brent is back to levels it was in December, it slumped at the start of the year, is a manifestation of a few things. There's the recessionary argument, which seems to wane, China demand coming back. But what's lingering under it all is what's going to happen with supply and how that happens. And, it's a story of two halves, because US stocks, crude oil stocks in particular, are continuing to grow. That shouldn't be much of a surprise in essence, because there's about 900,000 barrels a day of refining capacity that's down for maintenance at the moment. So it's not a particular surprise. But product stocks are, in ARA especially, gas oil, are lowest since 2008. So it's supply that's really driving it at the moment. China's just giving it a helping hand, really, on the demand side.
Malia Bengali, founder of MB Commodity Corner, sitting in the UK. Malia, the IEA yesterday forecasting an almost 2 million barrel a day demand growth for 2023, half of it to come from China. Are the markets getting ahead of themselves that China is the savior against the sort of global outlook for recession?
Thank you, Sean. I think you're absolutely right. I think the market is getting ahead of itself because it is easy to assume that China coming back means all the demand's going to come back. Having said that, the IEA also said that Russia will lose half of its production from last year, which they have not. We've seen the January numbers and the December numbers. Russia is surprising the market and actually exporting a lot more. And India actually has taken in 33 times more than last year. So it's all about getting rerouted. And China opening is positive, but we need to take into fact that the global economy is under recession. Manufacturing demand is causing weakness in demand in other parts of the economy. And China's opening will not just be a one-way street, it'll be a lot of bumps along the way. So yes, it's positive, but also China has been very smart in accumulating its inventories and its demand before the sort of reopening event. And the demand we feel is coming more from the import side, because they're actually producing more exports on the product side. So it's a really interesting game on the physical side. It's not as easy and cut out as everybody puts it out to be.
Let's welcome from India, of course, our regular commentator, Vibhuti Garg, Director of South Asia at IEEFA. Vibhuti, does India even care when China is back? India is roaring ahead, getting its nice, cheap oil from Russia and hitting those big growth numbers. Your outlook for India, does it matter if China's back?
Yes, India is looking at its own growth. So we are expecting that in financial year 21-22, we grew at 8.7%. So our GDP grew at 8.7%. And in 22-23, we are expecting that we will be touching about 6.97%. So these are the forecasts as per RBI, our central bank, and even from the World Bank. And in the coming years, again, we are expecting our economy to grow at 6 to 7%. We have already exceeded China's population. So I think there is a huge growing demand from the growing population. So I don't think so. The demand for oil is gonna keep continue to rise in India with the increase in population. And
And
as
where
we've
do you think
discussed,
the Russian demand, the Russian component for India going forward? Do you expect it to get more this year? Of course, last year Russia's discounted oil only came in the second quarter. Where do you think this year goes for India in terms of how big a factor discounted Russian crude will be?
I think it's going to be a big factor. Russia has become our top importer starting from October, November last year. So it's already exceeded the imports that India was receiving from Iraq, Saudi Arabia. And its share has gone up from 2% in 2021 to now about 25% of our imports are coming from Russia. So it's becoming one of the big country of our imports, of our oil imports. And I believe if they are continuing to offer oil at discounted prices, it's going to remain a big supplier. And as I said, we don't have any alternative to oil. See, for example, for other countries, if they were able to come up with other alternatives for as far as the gas is concerned, but as far as our oil imports are concerned, we don't have any alternative now. So we will have to import, and if we are getting it at cheaper price, and Russia is going to be a big supply, and that's one reason India has been able to tame inflation. For the very first time in December 2022, our wholesale price index inflation has gone down and is reaching a comfortable mark, which we had exceeded around 15% in the month of June 2022, but now it's back to about 4.95% in December 2022. And I would say Russia, getting supplies at a discounted price from Russia has been one of the big contributor for us to be able to curb that inflation.
Matt, the big sort of most tangible next sort of factor for the energy markets and the oil markets to digest is the EU ban on Russian products, oil products, diesel in particular, that comes into effect on February 5th. We've seen to date, now nearly a year into this war, any attempts or any efforts to stall or derail Russian oil exports has been unsuccessful. What is your outlook for the impact of the diesel or of the products embargo coming in 2 weeks' time?
Well, this is the point that's got to be raised. And as much as other trade patterns are forming, there simply isn't enough. There aren't enough other outlets, whether that's West Africa or Fujairah or India, wherever that may be. There's simply not enough supply at the moment. Lukoil, Gazprom, Rosneft, they still supplied 20 million barrels of diesel into the EU in December. Now, you think of a lead time on a cargo is say 4 weeks to arrive in Europe. That ship has literally already sailed. And the people who will benefit, as much has been much written about and we spoke about a few months ago, are the... Is that my camera? Sorry, something's gone wrong there. The Middle East refiners will benefit. The UAE, Saudi, India, China, to a certain extent, will benefit from picking up that lack of supply that Russia will leave behind. Just going back, what Vibhuti was saying regarding India. I mean, the numbers are shocking. In January 2022, India imported 2 million barrels of Russian crude. In January this year, they're importing 48 million barrels. So it's clear the way that it's going to go. Where that sits on the moral compass is to be discussed, and that really is what we're going to look out for in Q1 when data starts trickling in. If the EU got enough diesel, who's supplying it, how is it being supplied? So I think that the story is only just fabricating itself right now. But yeah, look, it's all eyes on where that product actually comes from, because the US are not there to supply it. Stocks on the core product stocks in the US, so jet fuel, gasoline, gas oil, they're at a 5-year low, and it's 25% lower than the 5-year average. So it's all eyes on what's going to happen. Chinese export quotas were high for a reason, so we'll have to see what happens in Q1.
Maliha, the European energy crisis that seemed to never really materialize in some regards, around gas, natural gas at least, is solved for this winter. All of the commentary coming out of Davos is indicating soft landing language and so forth. How big a challenge does putting an embargo on Russian products present for economic growth in Europe?
So you're absolutely right. I mean, last year around October and September, the whole world was convinced EU would be in a recession. But we spoke about this 3 months ago and said specifically that Germany and Europe had done a great job in securing about 90% storage 2 months before winter started. So natural gas is a seasonal game. We know that. So they had stocked up, even assuming a very cold winter. We knew gas would not be a problem for this winter. Having said that, spring and next winter is a problem. So Europe does have a secular energy problem, but on a season to seasonal basis, it's a very tradable market. And we've seen gas prices have gone from 350 down to 58 euros per megawatt hour. Having said that, they still do need to invest for the future. The recession has been avoided in terms of the near-term crisis. We've seen the euro rally, the European markets have rallied. So the market's getting a bit ahead of itself in terms of positioning. They were very much caught offside and being very bearish the euro, very bearish European markets, and that's why we've seen a resurgence in European bourses at the start of this year. But that doesn't change the picture in terms of the product side. We think the whole product ban is more about optics. We've been saying that for the last 6 months. I think Europe really needs to take a proper stance as to how they are limiting Russia's progress. Taking the oil from India and China, refining, getting it back into EU. They're still actually meeting their needs. Are they really not getting Russian oil? It's really interesting. We'll see what that does to the markets. But demand is a very important factor that no one's talking about other than the supply. And I think that's going to be the outlying factor for Q1 and Q2.
Vibhuti, you mentioned there how the Indian economy continues to sort of defy the global narrative. That we had the World Bank this week downgrade global growth to under 2%, but yet India looking very, very healthy. How is the policy around subsidy cushioning the impact, as you said, on inflation and on energy? And how long can the Indian government continue to provide such a significant amount of subsidy support for the population?
I think the biggest subsidies because of these oil prices have been on the fertilizers. So that subsidy burden for the Indian government has more than doubled. In fact, close to triple what Indian government was providing to the fertilizer industry. But as a result of high gas prices, and given India does not have its own domestic gas and has been importing a lot of gas for the fertilizer sector and even the green ammonia, not just the green ammonia, but the ammonia as well. So that has put a lot of burden on the exchequer. But at the same time, India has been kind of avoiding use of imported gas in other sector. Fertilizer, because of the food security reason, that's something which India cannot compromise, and have been importing expensive gas for use in the fertilizer sector. But wherever India can look for other alternatives, they are pushing for those other clean energy alternatives. We are betting big on, as I said, on electric vehicles for the transport sector. But all of these options are going to take time. India is giving big push on green hydrogen, and primarily for the use in the fertilizer industry. And because that is one of the big sector for us to reduce our import reliance. And that's where we see ourselves, reducing our trade deficit that we are witnessing now. So these are some of the measures that India is adopting, but all of these measures will not serve our immediate needs. It's going to take some time for these alternatives to be developed. Until that time, I think the Indian government will have to continue with the subsidies, with providing subsidies.
Matt, given the scale of Russian crude oil exports now moving into the east of Suez markets, and now if indeed the EU embargo on products has its impact, that might result in even more Russian crude because it won't be used to convert it into products for the European market. They'll export it as crude. So there may be more supply on the market, more demand for tankers. I wanted to get your sense of the impact on the tanker market by this increase in now, embedded traffic of crude moving into Asia that would otherwise have gone to the European markets, how that is being served by the tanker market?
Well, this is another very good point, and one that the market isn't really sure on the answer yet. It's the question that everyone is asking. But look, I think it feeds back to Maliha's point, which was excellent, is that if you can circumnavigate the sanctions by delivering the crude into India or China or somewhere that hasn't sanctioned Russian crude, and then re-export the products that the EU needs, you'd have to argue that enforcement of product ban is nonsense. So I think that it's going to be scrutinized, and I think the shipping market is seeing the same. Where do they position their ships? Look, I mean, it's a difficult one to argue right now because of seasonality. So a lot of the Urals that comes out of the Baltic Sea, the Russian fleet relies heavily on icebreakers. If you need floating storage, if it's a bit nippy, you wake up in the morning, your boat's stuck in the ice. I mean, I know that's not funny, but it's a logistical problem, and they need to have the infrastructure around it. It's this formation of new trade patterns. We're seeing a lot of Russian crude and Russian products end its way into, say, North Africa, off the coast of Algeria and Tunisia. Is that a diversion point? Because they can easily go back into ARA or down to West Africa. That gives them that option. Essentially, what it means for the freight market is that it just widens the divide between flirting with that sanctioned line and the clean market, especially, the MRs and the LR1s, they will remain high because there simply won't be enough ships. And what will happen is your ton per mile increases as well, because if the material that was coming out of the Baltic now has to come out of Jamnagar in India, well, of course, freight is that much higher, and that will go down to the end user. So it adds the inflation argument again. But essentially, freight is only on one way this year, and that's upwards.
Maliha, looking at the commentary of where we are with there's a big question of when we can say China's back, but the other big question is, can we say the Fed is done? These two big questions: China's back, the Fed is done. China's back seems an uncertain answer still. When we can say that, when could we say the Fed is done and done on its impact for the markets? Have we sort of bedded in all of this sort of Fed peak rates, peak inflation narrative, or is there more surprises there?
So the market all of last year moved from one extreme to the other. And back in November, we were very bearish China and very hawkish the Fed. Now we're very dovish the Fed and very bullish on China. So you're absolutely right. We feel the Fed is not done because, yes, the CPI is printing on, peaking, coming down, but they're still at 6.5% level. Even if we get a 4.5% print, we're still going to be by 2% at the end of this year. The Fed's going to be very cautious and pulling back. So a Fed pause and a Fed pivot are two entirely separate things. No one's even considering the fact that we stay at 5% higher for longer, which is a very sort of a tight market for asset classes to grow, economy to grow. So
which seems the most likely outcome to me if you start the sum of all the narratives. Out of Davos, it's recession, but a very light recession, i.e. Germany, America, soft landing idea. And a soft landing, rates would stay at 5% for as long as that's kind of the neutral position, perhaps.
Absolutely. Yesterday's Empire Fed manufacturing numbers shows an ISM print below 45. That's not a soft landing. So the market is really not positioned for anything other than a soft landing. We've seen the year's estimates as well. 2023 EPS numbers still trading north of $220. That's a 5% EPS growth. So the equity market's in a disconnect. We're actually assuming the Fed's going to save the day, pivot, we're going to go back up without actually feeling the pain. And we can't actually go through a scenario where we've priced in a recession, but don't actually see the numbers collapse. So you are right. I think the Fed's going to remain a hawkish rhetoric. They need to see a weakening in the labor market data. If the labor market gets really weak and we see indications of that, they might sort of take a reassess. But we haven't seen the numbers right now printed, and the Fed needs to always see the numbers print before they can do anything. So we feel the risk into next week's FOMC could be quite interesting on the dollar, the bond markets, and the equity markets, and to see what the Fed really has to say about the market.
Interesting. When India looks around the Vibhuti, of course, it's looking quite healthy at the moment, and obviously a very positive progress on the current fiscal year over the previous fiscal year, although down a little bit, but nonetheless way above the global trend line. What is the potential risk, contagion risk of those vulnerable neighbors? We have Sri Lanka to the south now is obviously in a very, very difficult fiscal position. Pakistan appears to be moving quickly towards, second behind Sri Lanka. Where's the contagion risk for India?
I think the way we have been able to protect ourselves is by harnessing more and more clean energies, renewable energy to our advantage. And that's where, at least on the electricity side, which becomes really the crux for higher economic growth because of its high correlation. I think using our own domestic resources of coal, so that's how we have protected ourselves, and then use of now more and more deployment of renewable energy is something that I would say has put us in a better position than our neighboring countries, and that's the way forward. Again, if you look at the budget announcement, the expectation from this year's budget is further to promote the whole renewable energy ecosystem. So there have been a lot of financial outlays, capital outlays by the government to push more and more domestic manufacturing.
We've seen India just last week, or this week even, tell the IMF that it strongly supports the Sri Lankan debt restructuring, which is seeking nearly $3 billion from the IMF bailout. Clearly, India is concerned.
I'm not too sure on that.
With Pakistan next door being a much bigger fish in terms of the consequence of that domino effect, I think it is a risk. I mean, it's one of the emerging risks of the new year, debt default in emerging economies, particularly in Asia, and we're going to have to keep an eye on that. Let's go to the survey question this morning. And get a view of the room, and we'll put out on social media today. In which quarter of 2023 will we be able to say China is back? We had the IEA, Fadi Birol, say yesterday it would be in the second quarter. Others have said the second half. But one thing the chief economist at the IMF said at Davos yesterday was it'll be quicker than we expect. So I welcome your views on that, when we'll be able to say China is back. Matt, oil prices stuck in the low 80s, you would say, despite all these dramas. The oil price seems rather nonchalant, uninvolved, unconcerned. What is your interpretation of these little moves up and down, $82 to $85 a barrel on Brent? Nothing to watch here.
Well, I mean, I think it's due for a wave up. I really do. I think there's a buying spree coming. It's, all financial markets have really started the year on a good foot. That's mainly down to a weaker dollar. Again, that's somewhat negligible in my view. I think the world is literally, if China are back, then globalization is back and everyone can hold hands again. But for me, what will drive the energy complex higher will be what happens with gas. Germany are, I think, 90% of stocks. Winter has been mild so far. What happens over the course of the year, because gas really last year was the driver of the whole energy complex higher because of, what secondary fuels be used for power generation. Germany is still in that equation, what with Greta and her mates camping out in a German coal mine. But look, the one thing for me, again, I bang this drum, but for me, it's what happens with diesel and gas oil in the EU. I think that's keeping refining margins buoyant throughout the world. Doing very, very well. Like I said, stocks in ARA and the US are well below the 5-year average. And it didn't take much, for the bulls to get, encouraged by stats like that only a couple of years ago before COVID. So I just think it's due a wave higher. I think it's when data starts trickling in on supply and how that is coming in vis-a-vis diesel and replacing that from Russia. I think the whole energy complex is due for it could be an easy 10% pop upwards.
Malia, your thoughts on that? Anything where you would see that would trigger breakout from these tight range? We've been stuck in the sort of bottom half of the 80s with regards to where the downside on global recession outlook versus the upside on China back.
Absolutely. So the demand figures for the EU and the US and global economy are very important for us. We know China is coming back, but the whole composite, along with what Matt said in terms of product inventories, are very, very important. So every week we are monitoring the demand supply balance between the inventories. But inventories being low is just not a bullish factor for enough. They've been low for the last 5 months, but yet oil prices have fallen. So demand is very important, and that research into the second half of this year. Fed policy in dollar, right now it's all about liquidity, and QE versus QT is still a big topic in the markets right now. So we think a lot of macro factors are going to drive asset prices, including commodities and oil, to break higher into Q1 and Q2. So we're in a very sort of precarious time right now. There are a lot of push and pull factors, but the main thing to look at right now, we think, is the Fed policy, because the market's very.
Where's the Fed likely to go? Obviously, on the tightening cycle in terms of rates creeping higher, the market's betting in a 25%, 25 basis point hike at the next meeting. But what about the idea of its balance sheet? Still at $8.5 trillion, tenfold over the last decade. How does it tackle that? What are the plans? What impact could that have on the outlook for the year ahead?
Absolutely. So they're about to start QT. The $95 billion per month has yet to start. So we haven't really seen QT begin in earnest. And also we have the US debt ceiling debate this Thursday, which is going to be interesting because it talks about US debt defaulting. We know how that
today is the day apparently where the debt reaches its limit.
Well, we know they always sort of reach an impasse where they say, right, we raise the debt ceiling even more. So I think this thing will be interesting. But from a liquidity point of view, you are right. We haven't seen the balance sheet fall down yet. So rates may have, even if rates pause, the balance sheet could be a big driving factor. We need to see exactly what the Fed does. But they have promised to take money out of the system, which usually doesn't tend to be very bullish for risk assets.
No, it doesn't. And when that starts and how aggressive it starts, I mean, you would think to a certain extent, this is an opportunity for the global policymakers to return monetary policy to a historic normal place, i.e. 5% is the neutral rate. Fed balance sheets are back down to something, this is an opportunity before the next crisis comes, but perhaps that won't be taken. Vibhuti, last word for you today. Looking at the survey results, we're looking at a Q2. China is back to a Q3, second half of the year. What does it mean for India, Vibhuti, from the point of view of the LNG and gas? We've seen obviously Europe pull a lot of LNG away from Asia over the course of 2022. Now with China back, from the point of view of was the world's biggest import of LNG before its COVID lockdown. What does that mean for India?
I think the prices have skyrocketed, and definitely India is a price sensitive economy. So clearly, if the prices are going to hover around $25 per MMBTU, which is currently the case, we will see decline in the LNG consumption going forward. So we know it's only below $10 is what the Indian economy can absorb. So if the prices are anywhere above that, for most of the sectors where LNG is consumed, it does not make commercial sense for it to use LNG. So yeah, the consumption will keep going down if the prices are gonna keep remaining high. So yeah.
Is coal the switch substitute for LNG in India?
Coal or diesel as well, which is again expensive. But where for
coal isn't cheap either.
Coal,
but obviously cheaper
domestic
than LNG.
coal.
Yeah, domestic coal,
domestic coal is cheap.
Right.
But as I said, the other alternatives that are being looked as is, say, for example, in case of oil, ethanol blending is being looked for running transportation. Then green hydrogen, as I said, is going to take time. But again, a big push is being given to green hydrogen in India again.
Well, the China back is definitely the continuing narrative of January until maybe the Fed really starts to come into fore, and if there's any debate around the Fed being done and what peak rates look like. But China back, of course, is quite a significant factor in the LNG markets. And we could see, as warned by the German Energy Agency on our platform last week, that the Europeans could be shocked by how quickly LNG prices spike again if China re-enters that market and starts snapping up some of those spot cargoes. So still a lot to play for here in the direction of the market, which it seems from an oil point of view, at least, with oil trading at Brent at 84.33 this morning, showing that it's still sitting on the sidelines, not really sure whether to go up or down, and so we'll do nothing for now. What will give it direction, we'll have to wait and see. Thank you so much. Really great to have you guys back at the table. Of course, Matt Stanley at Kepler, Malia Bengali at MB Commodity Corner, and Vibhuti Garg at IEEFA in India. Thank you guys. Have a great day. All the best.
Cheers. Cheers,
Thank
guys.
you.